Hey, Dustin Tibbetts, financial advisor here with Jazz Wealth. How you doing? It's weird. We're here on a Saturday. It's a brand new episode of the Doe Show. We're doing things a little different today. I've actually got a studio audience with me. I'm going to just pull them in here real quick so you guys can see them. They're all there. Wave, say hi, make sure. I love it, I love it. So we're actually doing just a little meetup here to kind of help people with video creation and everything. And today I want to sort of show them how we do what we do. So play along. I see some of you already in the room there. Let them know you care. We're doing the right thing. I am a financial advisor. I wear the shirt. You can tell who I am. You can check out the website. If you won't, maybe I'll help you with something you've never learned before, and you'll hit the subscribe button. But if you're working with a financial advisor and he's not helping you, he doesn't talk to you, he's not helping you in any kind of a way, hey, check us out at jazzwealth.com. I'm going to ask you a question tonight, and I'm going to start with those of you in the room. If you have an answer, feel free to shout it out. If you're in the, whatever you call it, the chat thing down below, let me know. What do you think, if you invest in the stock market, I'm going to use the S&P 500 tonight, what do you think is the average return you can expect to make? Anybody want to take a guess? 10%. 10%? Anybody else? 4? 2? Wow, that's not very good. You're not too optimistic. Okay, so let's think about it. There's a 90-year history of the S&P 500. Over those 90 years, the S&P has returned an average of 9.8%. So very, very close. You see people go, no, Dustin, that's not right. You're an idiot. It's not 9.8%. It's 7%. Why do people say 7%? 9.8% is the raw number, right? So if you look over all the 90 years, you average it out, you come up with 9.8%. But a lot of people like to back out inflation. So they go, inflation 2.3, 2.5, 2.8%. Let's round down, let's call it 7%. And so that's the reason why when you ask financial advisors, you ask traders, investors, whoever, they go, well, assuming you're invested correctly, 7% is your average return. Now, I get this call a lot. I get this question all the time. People go, Dustin, my financial advisor, he sucks. He's not very good. I didn't make 7%. It just didn't work out. So is he bad? Am I not invested in the right things? Am I paying too much in fees? Well, you know from this channel, I don't bash on people. I try to keep things positive. But it made me think, and I did this video a couple weeks ago for our customers to kind of illustrate, if the average return is 7%, how often do you get 7%, right? And so we look back through the whole 90-year history of the S&P 500. I'm going to zoom in just to show off to the people here in the studio. But how often do you think you see a return of 7% in the overall stock market? Any guesses? Is it 9% of the time? Is it half of the time you see returns of 7%? What do you think? You take a guess. You nailed it.
My gut said 50.
50% of the time you see a 7% return. So theoretically, every other year, I should look like a hero, right? I got you your 7%. You were looking for it. I got it. In reality, you see 6.7% of the time, you'll see a 5% return, a 6% return, 7, 8, 9, or 10% return. It doesn't happen. So if we were to take a look at I call it the distribution of returns, basically. It's a fancy way of saying it there. 6.7% of the time, you're going to end up with a return of 5%, 6, 7, 8, 9, or 10%. Barely ever happens. So when I get the call from people that say, wow, my advisor sucks, it's not that he sucks, it's that he's probably following right along with the stats. So the markets barely ever return 0%, they barely lose 2 or 3%, they barely make 3 or 4%. So what gives? If most of the time they're just returning, or if they're hardly ever returning a very small percentage return, then what's going on? Well, there's two things that actually drive the market's returns. You know what it is. Anything you invest in, what drives investments? Fear and greed, right? So if we look at the average distributions of the actual stock market, let's take a look and see, I'm going to get fancy again. If we look at the returns of the stock market, how often do we return more than 20%? How many times does Dustin here at Jazz Wealth look like a hero? 20.7% of the time. 27% of the time. That is a 7. So 27% of the time, the markets return greater than 20%. So you go, my advisor doesn't suck. He's great. He made me 20%. A couple years ago, it was 22%. Last year, it was not 22%. It was not very good. So most of the time, we've got greed, right? People are just like, yeah, the markets are moving higher. I want in. Get me going. Let's go, let's go, let's go. And we end up with a greedy market of 27%. Now, how often does the markets tank, right? The fear part of things. How often does that happen? Less than 10%, or how should I say it? The markets return less than, or do you say greater than 10%? How would you actually say that? Greater than a 10% loss 20% of the time. It's actually 21.7 if you want to get really geeky on me. So for the most part, you have a stock market that's either losing a lot or gaining a lot, and all of that time you think, my advisor sucks. He's either losing me money or he can't consistently make me a lot of money. The bottom line is fear and greed, right? So the markets barely ever lose any money because that's not exciting, right? There's always some reason to be scared. Trump, Clinton, Bush, Obama, that's as far into politics as I go. Someone always hates the decisions that all of those people made, and they think it drives what the markets do. The bottom line is go back through the 90-year history of the S&P 500, and who cares? There's always been a gas shortage, a war, you name it. We've all kind of, 2008, there's your great example of greed. You bought a house, your dog bought a house, it went up $100,000 in value, you sold the house. So there's all these episodes of fear and greed. That's why the markets typically respond in a very scary way or a very positive way. The bottom line between everything I've said today is you're not going to get 7%. You're not going to get 5%. You're not going to get 6%. You're not going to get 8% or 10%. You're very likely going to see a return of much more or much less. The average, stick with it, the average over the lifespan of what you're doing is 7%. It's actually 9.8%, but if we give everybody credit for inflation and we give, 2.8, 2.3, whatever we agree on, it's 7%. And so that is all I have for you today. If I helped you in some way, maybe you'll hit the subscribe button. Of course, I've mentioned Jazz Wealth a million times, and this shirt tells you exactly where to go if you want help. But if you don't need me, you like investing, maybe you'll just hit the subscribe button. I want to thank everybody in the audience for joining me and being really quiet. No sneezes, phone drops, or anything. Very nice. We will be back on Tuesday because the stock market is closed on Monday. So I'm going to sleep in, and then I'm going to get to work and catch up without anybody bothering me. And I'll see you guys on Tuesday. Thank you so much for watching. We'll talk to you soon.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new FinTips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.